So now we have the Fed on watch still. They are not going to ease. Their fingers still on tightening. ECB, Bank of Japan, and Bank of England, all still probably done tightening, but they're not even started easing. That's been my iteration. Let's get to the first bridge of the start, take out that priced in tightening, and then the start ease, and then we can think about when risk assets will bottom, and they're just getting started. So reiteration from our economics team this morning, Bloomberg Economics, the recession will hit by the end of this year. I think it's going to start it. And Anna Wong pointed out virtually every time we've had significant recessions, 3 or 2 months before that, you see non-farm payrolls plus 300. Now, we've just seen that pretty strong number.
The Bank of Japan further loosened its grip on long-term interest rates by tweaking its bond yield control policy again on Tuesday, taking another small step towards dismantling its controversial monetary stimulus of the past decade. While it kept ultra-low interest rates steady, the BOJ watered down its 1% cap on the 10-year bond yield, which it set just 3 months ago to allow long-term borrowing costs to rise more. The bank's 9-member board also revised up its price forecasts to project inflation will well exceed its 2% target this year and next, underscoring a growing conviction that conditions for phasing out its super loose policy are falling into place. In this video, we are going to listen to Mike McGlone as he reviews the macroeconomic conditions, which is the opposite of what we have been seeing in the crypto world. He reiterates his recession calls and also talks about the price impact of oil as the war in Gaza rages on. As you watch, don't forget to hit the like button, subscribe, and drop your comments.
The word hopium for the bulls is what's happening. It's rallying and closing strong on Fridays because people are afraid to be short for the weekend because of what might happen with escalation in the war in the Middle East. Now, remember, when you're people like we are, you've heard that term war in the Middle East since you were children. Unfortunately, it's just something we've grown up with. It's sad, it's horrible. But the thing is, will it do anything to significantly cut the supply of crude oil, like the Arab oil embargo in 1973 and in 1979, the raiding of the U.S. Embassy? And it's very unlikely. So here we are back Monday. WTI is around $84 a barrel. The average price this year is $77. Most people last year said there'd be a 1 in front of that handle. And yes, if you want to blame someone, I think it's going to 50 or below in a normal recession. And that's already what's happening. So crude oil has bounced, but it's up 4% in the year. Gold's up about 10% in the year. So that's a significant, and copper is down about 5%. So from a commodity standpoint, that's a clear recessionary trajectory. The only thing they need the next shoe to drop is for crude oil to fall with the U.S. stock market. So we just got off our morning meeting, and something that was completely expected is lower prices are begetting lower prices, almost all risk assets. So we're at that stage now. It's crude oil is going down because the stock market is going down. And why is that going down? Because the Fed's still tightening. So now we have the Fed on watch still. They are not going to ease. Their fingers still on tightening. ECB, Bank of Japan, and Bank of England, all still probably done tightening, but they're not even started easing. That's been my iteration. Let's get to the first bridge of the start, take out that priced in tightening, and then the start ease, and then we can think about when risk assets will bottom, and they're just getting started. So reiteration from our economics team this morning, Bloomberg Economics, the recession will hit by the end of this year. I think it's going to start it. And Anna Wong pointed out virtually every time we've had significant recessions, 3 or 2 months before that, you see non-farm payrolls plus 300. Now, we've just seen that pretty strong number. I looked from our interest rate team, Ira Jersey, pointed out the big deal this week is that refunding. 114 billion treasuries. I remember trading in treasuries, and 40 was a lot. So here, what that is, that's a giant black hole of high yields, guaranteed. People know, I bet at this conference, people saying, where do you put your money? I'm like, well, what's wrong with the 2? And that higher yields is sucking that money from risk assets. It's actually pressuring things like housing and anything that's related. So I'll point out that to me is a key thing. And also we have this dollar bull fatigue. So what's it going to take for that wrecking ball of the dollar? I mean, the yen is above 150 now. Is basically you need yields to fall, U.S. stocks to fall, and that's part of the worst lose-lose. So I'll end with this. Since the U.S. government, went above 5% on the first day, it really sustained above that level on August 21st. The S&P 500 is down about 7%. Gold's up about 5%. And crude oil still hovering up 3% or so. I think everything is going to tilt lower, and that's what's good for gold. And the bottom line is Bitcoin is showing divergent strength in this environment.
One of the hottest investments on Wall Street is something of a surprise. It's a battered, long-dated Treasury bond fund. Shares of the iShares 20-plus year Treasury bond ETF, TLT, are near a 16-year low and have lost more than half their value from their 2020 peak. But investors are piling in. They added more than $2 billion to the fund on Tuesday and Wednesday alone, bringing its total inflows for the year to $21 billion. McGlone shares his view on that, throwing caution to the wind for investors and traders alike. Here's what he had to say.
One of the worst performing assets last year was GBTC. It's one of the best performing this year. I still bullish that asset, but TLT has been one of the biggest surprises, particularly here. Guilty, wrong. I didn't think long bond 10 years ago about 4%, but now they're 5%. I think they're going to drop on the elevator towards 3% with the deficit ballooning, with QE that you mentioned. Now that's a bridge to come to, and then it's after that I don't know what's going to happen. We're going to unfortunately, we might get austerity. Republicans come in, they're talking austerity already with the new Speaker of the House. So what does that mean? That's a depression. And that's kind of what they did in the 30s. And we raised taxes, and we had Smoot-Hawley Tariff Act and things like that, but we're tilting that way. So in the macro right now, I think this is pretty significant that we're seeing this asset that's 3 times the volatility of the stock market and gold, Bitcoin, doing well when everything else is tilting lower. Now, the key thing about the stock market you have to look right now is, yes, 14-day RSI is oversold. When have you ever seen a bear market that doesn't get oversold? And this is historic and epic. And the key thing I want to point out in my presentation is never forget where you came from. And it's a simple fact that if you use a simple Warren Buffett model versus the S&P 500, just a year ago was the most expensive since 1936. We're just simply reverting the most historic period in history of low interest rates. The facts have changed. Okay, and here we are working on a day-to-day. Everything that's a risk asset is supposed to go down in the environment, and that's why the federal government is part of the problem now. They've borrowed so much, we're at the limit now. And you mentioned, Dave, at some point there's going to be QE because the Fed can do it, but they're going to have to. And also, a lesson I learned last year, I remember with some of my colleagues who were bullish crude oil right before the midterms. I'm like, don't underestimate what the world's largest producer, what helps get a sitting electors, politicians elected. They need lower crude oil and things like that. So expect pretty strong austerity, not austerity, but priming the pump. And at some point, this is epic, but this to me right now, the situation I see around is very akin to 1930. Stock market went down 50% in 1929, rallied 50% and rolled over, and everybody thought it was over. All the indicators we have, it's just getting started. That was just the warning sign. So the key thing is they're supposed to issue 3s, 10s, and 30s securities, 114 billion. And if they issue a little bit less 30 years than the market anticipates, which I think they will, that will give you a signal that, okay, well, we're starting to focus on this spike in long bond yields, and we think it's serious. And we'll see what happens. But right now, the market's already expecting that. I mean, it's expecting the supply. The key thing is when the supply comes on, if it spikes yields shorter term, that's just a black hole for risk assets. You see the lose-lose here. The Fed's going to keep borrowing. The Treasury is going to keep borrowing. And at some point, it's just going to be overwhelming when people realize, okay, well, these yields are just too attractive, and I got to lock up and protect myself. And every time they inch higher, I pointed out what happened with the 2 note, above 5%. All risk assets, they just have that ceiling, that wall of resistance above them for this massive need for borrowing from the safest risk assets on the planet.
The Fed's latest monetary policy meeting is set to begin Tuesday and end with its latest interest rate decision on Wednesday. Markets are widely expecting the Fed to keep rates unchanged and are hoping for hints about whether it's likely done raising rates from guidance released alongside the rate decision and Fed Chairman Jerome Powell's post-meeting press conference. Several policymakers have said they believe rates won't have to go any higher in recent weeks, often citing tighter financial conditions brought on by higher Treasury yields as a key factor. Higher yields are often associated with an easing economy. Investors also assessed the state of the economy after the U.S. Treasury shared its borrowing plans for the final 3 months of 2022. The Treasury is aiming to borrow $776 billion, which is below the previously expected amount. The U.S. Treasury Department said it expects to borrow $776 billion in the final quarter of this year, and most the government has ever borrowed during the fourth quarter. The forecast is $76 billion less than the estimate Treasury made in August due to higher than anticipated tax collections in October. That's partially a result of deferred tax collections from residents and corporations in states like California, where tax deadlines were extended due to extreme weather, Treasury officials said on a call with reporters on Monday. Treasury's new estimates will inform the size of upcoming auctions for bills, notes, and bonds, the details of which are set to be released by the agency on Wednesday morning. Yields on Treasury-issued debt immediately slid following the announcement but started to bounce back not long after. Yields have been elevated in recent weeks for a variety of reasons, one of which has been concerns about how much money the government is borrowing. The updated estimate likely means Treasury will issue fewer bonds this quarter than investors were bracing for. When the Treasury issues more bonds, it often causes bond prices to go down, which in turn pushes yields up. The Treasury also said it expects to borrow $816 billion in the first quarter of next year. That would also mark a record level of borrowing for the first quarter. Meanwhile, last quarter, the government borrowed $1.01 trillion, or $277 billion more than the Treasury initially estimated in May. Are we going to see the recession this year, or will McClellan be proved wrong? Let us know your thoughts in the comment section below. Also remember to hit that like button, subscribe, and turn on notifications. Thanks for watching.